You know how you hear people say that I have, for example, 60% of my portfolio in stocks and 40% in bonds. So I am actually quite balanced in my portfolio. But what does this really mean? Or you may hear the term diversified portfolio being thrown around as a very common term. But how do you really juggle between the risk and the reward? Well, today we will look into some example portfolios to really understand how allocations can be done. We'll look at Vanguard's allocation models. They have a really neat page that really shows the different types of portfolios. If you don't really know Vanguard, they're an investment group with over 7 trillion global assets under their management. In other words, they really should know what they're doing. So I'll put this page in the description as well. And this page has been around for quite a long time. They update it on a very regular basis on for example, the average annualized returns, as well as some other statistics for each portfolio type. It is separated by different goals that people may have. On a high-level overview, they have 3 main categories, and for example, income, as well as growth, and there's one in the middle, which is balanced portfolio. These portfolio allocations also neatly describe the average annual returns, as well as how many years did the portfolio encounter a loss. So let's start with the income portfolio. The income portfolio consists of a dividend-paying stocks and some bonds. So if you look at the percentage, it is very heavily reliant on bonds. They are even separated into 3 different types of income portfolios. The first one being 100% in bonds. So these portfolios are really looking for low risk, and they are looking at maybe short to medium term outlook. Because they are very low risk, for example, the investor can take out their money almost at a better time compared to if they have more on the stocks. But one thing that you want to that's interesting to look at is, even if we compare a portfolio that's 100% bonds versus a portfolio that's 20% in stocks and only 80% in bonds in this case, the one that has stocks in their portfolio has a higher average annual return. In this case, 7.5% compared to 6.3%. That's a decent percentage higher. And also, even if you look at years with a loss, if you have stock in your portfolio, you actually minimize the risk. So contrary to belief, when people think that bonds may be a low risk and they don't want to invest in stocks because of that, that's not actually true. You do want to have at least some percentage in stocks, so that way it is still minimizing the risk. Of course, if you have only stocks and no bonds, that's definitely way higher risk than if you have 100% in bonds. But in a general sense, you want to allocate at least a small percentage, in this case 20%, into stocks if you want to have a low risk but still have some kind of decent rewards. If we compare the 20% stocks versus 30% stocks, again, when the stocks percentage goes up, it is pretty clear that we usually have a higher return. In this case, it's not as high, but it is still a decent 0.6%. And we also increase the risk a little bit because there is now 2 more additional years with a loss compared to the 20%. All right, so the next category is the balanced portfolio, and they have a more equal allocation between stocks and bonds. But notice that as allocations of stock increase from 20% upwards, there is definitely an increase in the number of years with loss. Starting from 30% or starting from 20%, we saw 16 to 18. Now with 40%, we see a 19, and 50% is 20, right? So there are more and more years with a loss, and but overall the average annual return is increasing as well. So what does this mean? This means that, again, increasing the stock percentage in your portfolio will introduce more risk, means more volatilities. Because stocks in general are more volatile, so there are years where you might not be doing so good. For example, this year, 2022, is likely not to be a good year for stocks holders. However, this does not mean that it will continue for the rest of the decade. On a average basis, the stocks do tend to have a higher return compared to bonds. Lastly, let's look at the third category, which is the growth portfolio. This mainly focuses on long-term horizons. These investors have a high percentage in stocks compared to bonds, although the annualized return is only a few percentage or less than a couple percentage higher than a balanced portfolio. It definitely has more years of loss compared to balanced portfolio as well. Again, as we have seen, when we increase more percentage in stocks, there is more likelihood for more volatilities in your portfolio as well. So you can see that on a worse year, right, there could be a minus 30% in the portfolio, where if you have 100% in stocks, the worst year in 1931 was almost minus 45%, so 43% in this case. So that's a huge loss, right? Imagine the psychology aspect of this. If you're an investor and perhaps you're very new to the game, and in 1 year you lost a third of your portfolio. If you invested in $10,000, you lost $3,500 already, or more than that. So if that's the case, it's gonna have a significant impact. You might be less likely to invest more, or even worse, you might take out your portfolio at the worst time because you actually need the money or something. So that's why you have to also account for how risk averse are you. Do you want to make sure that you leave some room for error in case there may be a time where you need the money? Then perhaps you shouldn't look at such a long-term horizon where there will be years you might be losing a lot of money on. I also want to quote a famous investor, Benjamin Graham. And if you don't know him, he is the mentor of Warren Buffett as well. He has mentioned in his book, The Intelligent Investor, where he advises younger people to have a higher allocation in stocks, meaning usually a growth portfolio. Maybe 70% and 30% in bonds, 70% in stocks, 30% in bonds. Whereas he advises people near their retirement to focus more on a income-based portfolio, meaning that there is more bonds rather than stocks. The reason is because as a younger person, you will have more years to grow your portfolio, right? The best way, of course, is to leave your portfolio forever, to never really touch it, but that might not be likely for everyone. So in that case, it really depends on how long do you think you can leave your portfolio untouched to choose what kind of allocation you would have. I hope this gives a general idea of the portfolio allocation. We'll definitely go in more depth on, for example, what kind of stocks and bonds to choose with this series. But it's also really important to understand how do you allocate based on your risk tolerance, based on your reward, based on your timelines. If you enjoyed this video, please remember to like and subscribe because this will help my channel tremendously. Thank you.